Hi, I'm Helen Forster, and this is a debrief of Section B of the TX mock exam. In this exam, we have 3 scenarios, one of which is on VAT, one on inheritance tax, and one on capital gains tax. So that is usually the way that it's going to be in the real exam, although there are no guarantees. So in theory, any subject could come up here. But VAT, IHT and CGT are ones that we do very commonly see tested in the exam. And I'm going to run through each of these cases, starting with the VAT case. So this is a typical case study. We have the information on the left side and then the questions on the right-hand side. All of the questions are independent. So if you get one wrong, then you can still score full marks for the other ones. And this first question on the VAT scenario is all about VAT registration. So you will tend to find in the exam that the questions follow the order of the information on the left side. So this uses the information about the sales, and we have to advise from what date Zara would have been compulsorily required to register for VAT and start charging output VAT. She has actually registered voluntarily, but if she hadn't registered voluntarily, when would she have had to register? And for this, we can get some help from the tax tables. So in our tax tables, we have got the VAT registration limit, £90,000. And here, looking at the amounts, they're all quite small figures. So that means that we are going to be applying the historic test. So we look back at the past 12 months. And if we go over £90,000 in the past 12 months, then we have to register for VAT. And if somebody has just started to trade, then the first thing that we might want to do is just do a rough calculation of their total taxable supplies for the first 12 months, and then we work on a rolling 12-month clock from there onwards. Now in this case, if we actually add up all of the taxable supplies for the first 12 months, so we have 4 months on 7,500, 4 months 9,500, and then the next 4 months on 11,500, that actually takes us well over the limit. So we then need to go back a couple of steps and work out at what point, at the end of which month during those first 12 months, the limit is breached. And if we work month by month, so let's just say if we did the 9 months to the end of September, that would take us up to 79,500. We're getting pretty close there. And then if we add on one more month, 11,500 for October, then that takes us over the limit. And if the limit is breached at the end of October, just be careful here. You've got 30 days to notify HMRC, which is one of the dates that's given here, and the registration will be effective from the first day of the second month. So if we go over the limit in October, November, December is the second month after the limit, and we would have to start charging VAT, which is what the question says, from the 1st of December. Be very careful here because those dates are all very close together. 2 marks for a correct answer, nothing if you get a wrong answer. Our next question is about pre-registration input VAT, the information that we need here. We've got some details about costs incurred by Zara before she registered. So we're now assuming that she registered on the 1st of January 2024. And you need to remember that pre-registration input VAT can generally be recovered on any goods or assets that were purchased in the 4 years before registration, as long as those are still held, and on any services in the 6 months before registration. And we have the purchases here. We've got the purchase of a car and we've got some services. Well, unfortunately, cars are not going to be allowable where there's any sort of private use. You can't claim back the VAT on a car. And for the services, we have amounts in March and we've got amounts in September 2023. So it's just the services in the 6 months before the 1st of January 2024 where we can reclaim the VAT. I've just highlighted as well that these figures are the figures exclusive of VAT, So the answer that we want then, we can just claim back 20% on the £2,000, which is the answer number 3. And the other answers here, if you chose 640, then that actually claims back the input VAT on both of those service costs. The 2160 claims it on both of those costs and the business percentage of the car, which might seem quite logical, but unfortunately is wrong. And the final answer claims back just on the £2,000 of services and the business percentage of the car. So as always, watch out, because the wrong answers are quite plausible answers. So sometimes it is worth looking at how those might have been calculated if you're not 100% sure of your answer. The next question is about tax points for VAT. And we have to identify the tax points for a deposit and a balancing payment for the bespoke necklace, and the information down near the bottom there, the bespoke necklace. So Zara received an order, customer paid a deposit, she dispatched the necklace, issued an invoice for the balance, and then the customer made the payment sometime later. And it's quite a clever question, this one, because we've got a choice of all of the dates mentioned, and we have to click to say which is going to be the relevant date for the deposit and which is going to be the relevant date for the balance. You need to remember that for VAT, the basic tax point is the date that goods are supplied. And that's the date that we use as our actual tax point, unless we receive cash or issue an invoice before that basic tax point. If we do either of those things, then we pick the earlier date. Or if we don't do either of those things before the basic tax point, but we issue an invoice within 14 days after the basic tax point, then we can move the actual tax point to that later invoice date. And if we go back to the information that we've got here, the receipt of an order is not relevant, so we can ignore the 1st of February. We've got the date of dispatch as the 1st of March. That will be the basic tax point, which is one of our options. However, we have got a deposit, so this is cash received before that. And for that deposit, we are going to take the tax point as the date that it was received. We've then got an invoice for the balance issued on the 12th of March, so that is within the 14 days after the basic tax point, so we can use the invoice date for that balance. And the answer then, we have two different dates, 10th of February and the 12th of March. Then we've got a question about the flat rate scheme for VAT. And this one is a fill-in-the-blank question. We have to work out Zara's monthly VAT payable if she joins the flat rate scheme, and we're given the flat rate percentage. And the flat rate scheme, we've got some details of Zara's turnover and her purchases. But for the flat rate scheme, the VAT payable is simply going to be the flat rate percentage multiplied by the VAT inclusive turnover. And the turnover we've got is 11,500. As we said before, all of these figures are exclusive of VAT. So we need to add VAT to that turnover figure at 20% and then multiply it by 7.5%. Ignoring the purchases. So 7.5% of the VAT inclusive turnover is instead of doing output VAT less input VAT. And the answer then, 1,035. And the final question is also regarding the flat rate scheme, but this time we don't actually need any of the information from the scenario. This one is just a pure knowledge dump. Which two of the following statements are true if Zara joins the flat rate scheme? You either knew this or you didn't, but you need to have a guess if you don't. And the correct answers: she does have to still charge output VAT on standard rated supplies. And if Zara's total VAT inclusive turnover for the previous year exceeds 230,000, she would have to leave the scheme. Those two statements are true. The other statements are not true. So Zara would in fact still have to issue invoices to customers, And if you join the flat rate scheme, you can actually use the annual accounting scheme as well. Be careful with these. Although it's 2 marks, you either score 2 or 0. If you just got one of those right, unfortunately, you would score 0. So think very carefully. Our next scenario is all about inheritance tax. We have some new information and 5 questions based around that information. And the first one is a calculation question, and we're asked to work out the gross chargeable amount of the chargeable lifetime transfer on the 20th of August 2017. We've got some detail about Byron's lifetime transfers, and the one that we're looking at is this chargeable lifetime transfer of £340,000. Note that it does give us the value after exemptions. So what's the gross amount of that basically to carry forwards? So we start off with the 340,000. We would deduct any exemptions, except that it says that that value is after the exemptions. Then we need to think about the nil rate band. Now the nil rate band is £325,000. And we look back 7 years before the date of this transfer to see whether any of that has been used up already. Now we do have one transfer in the 7 years before this one, but at this point it's a potentially exempt transfer. So when we're working out the lifetime tax on a lifetime gift to work out the gross amount to carry forwards, it's just gross chargeable transfers, so that would be CLTs in the 7 years before this one, that will affect the nil band. That gives us a taxable amount of 15,000. And then the tax on that, nice way of remembering this is if the donee pays the tax, then it's 20%. If the donor pays the tax, then it's a quarter or 25% or 20/80ths. So basically, if the donor pays the tax, we treat the gift as if it's net of tax because the gift and the tax are going to go out of the estate, and then the tax is 20/80ths. And in this one, we do know that Byron paid the tax. We would assume that if we were not told. So the tax is at 25%, and the gross chargeable amount is going to be the gift plus the tax. So it's the value after the exemptions plus the tax that would be carried forwards. And that gives us our answer, the second option, 343,750. And for this one, as long as you knew that for a CLT where the donor pays the tax, we have to add the tax to get the gross amount, you could immediately eliminate the first one. Option 3, 343,000, is what you would get if you applied 20% and added it on instead of 25%. And the final option, so the 381,250, is what you would get if you did deduct the value of the pet from the nil rate band before following through those calculations. The next question doesn't need any of the information from the scenario. We're just asked to state for each of these statements whether it's true or false. So you either knew these or you didn't. We've got 4 different statements and you have to get all of them right to score the 2 marks available. So the first one, a marriage exemption of £2,500 is available for a lifetime gift to a nephew. You do need to remember the marriage exemptions. Unfortunately, those are not given in the tax tables. And for a nephew, it would in fact be £1,000. £2,500 would apply for a gift to a grandchild or the bride giving to the groom or vice versa before they got married. But that is not correct. If an individual makes 5 gifts of £240 to each of 5 different individuals in a tax year, those will be exempt. So that's true. The small gifts exemption applies for gifts up to £250 per person per tax year. If a pet is made before a CLT, then it will use the annual exemption even if it never becomes chargeable. So that's just the way it works. And then finally, any unused annual exemption, remember that that can be carried forwards for 1 year. It says should be used before the exemption for the current tax year. Well, that is false. We have to use the current year exemption before we use the brought forward one. So all of those correct gets you 2. If you make any mistakes, unfortunately, you would score 0. Then we have a question about the nil rate band and the residence nil rate band. So the nil rate band, which is £325,000 and has been for very many years now. The residence nil rate band you can actually get from the tax tables, and that only applies if we have a main residence. So we do here have a main residence which is being left to a direct descendant, so a child or a grandchild. So that is going to apply here because Byron is leaving his estate to his daughter. So we can get the residence nil rate band on the residence, and we've got the basic nil rate band, and because Byron's wife died a few years ago, she hadn't made any lifetime gifts and left her entire estate to Byron. So that means that her estate would have been exempt as a transfer to a spouse. So we can actually transfer her nil rate band, and if she hasn't used any of it, we can get the full 325, and we can transfer her unused residence nil rate band as well. So these are given in the tax tables: the nil rate band 325, the residence nil rate band of 175,000. And the question is, what's the maximum total amount of those two that is available to set against Byron's death estate? Now you do need to be a little bit careful here, because we have both of those 175 nil rate bands, but the house value has to be reduced by the mortgage, and you can't claim more residence nil rate band than the value of the house that actually goes into the estate. So in fact, we would have to restrict that to 250, and then we've got 2 normal nil rate bands. And if we look back 7 years for Byron's nil rate band, those 2 lifetime gifts are actually more than 7 years before his death, so they won't have any impact on the nil rate band available. So the answer is £900,000. Quite a tricky one. And for this one, if you chose £500,000, then you ignored the transfer of the unused bands from his spouse. The £825,000 forgets the spouse's residence nil rate band, so that's just the 325 transferred from his wife. And then £1 million, which I think is the easiest mistake to make, is if you didn't reduce the value of the house by the mortgage and so claimed the full 350 of the residence nil rate bands. So slightly sneaky question, that one. Next question. Which 2 of these amounts would have been deducted or excluded when we worked out the value of Byron's death estate? So we have a list of things that we need to decide which of those is, if it's an asset, going to be included, or if it's an amount owed, which is going to be deducted. And we have a chattel valued at £3,000. Now that would have to be included. It would be exempt from capital gains tax, but not from inheritance tax. We can deduct Byron's outstanding income tax. That is an allowable expense. The debt owed to his sister would be allowed if it was legally documented, but it isn't, so it's not enforceable. ISA investments are exempt from other taxes, but not from inheritance tax, so that could not be excluded. Funeral expenses can be deducted, but not fees paid to the personal representatives. So 2 correct answers, both of them right, scores 2 marks. Any mistakes, and we're back down to 0. Then the final inheritance tax question is all about due dates and who pays the tax. And for inheritance tax on death is going to be due 6 months from the end of the month of death. We have Byron's death on the 15th of February 2025. 6 months from the end of that month means that we are in this 31st of August column. And who is responsible for paying the tax? This is another slightly sneaky one. It will actually be the personal representatives who pay the tax to HMRC. The beneficiary will suffer the tax. Sophia will receive the estate net of tax, but she won't actually be responsible for paying it. So the answer is payable by 31st of August 25, and it's the personal representatives who will have to pay that. And that leaves us with our final scenario, which is the capital gains tax scenario. We have separate bits of information on the left here for the 5 questions, all relating to capital gains tax. First of all, we have a question involving a part disposal. So the question is, what are the total deductions which will have been allowed in calculating the chargeable gain on the disposal of Ash's 3 hectares of land? This is this first bit of information. We have Ash originally purchasing 5 hectares of land for £70,000. So that's our cost. And selling 3 hectares of that land for £150,000. And the idea is that we can only deduct part of the cost because only part of the land has been sold. Be careful, the number of hectares is totally irrelevant. When you have a part disposal, you multiply the cost by A over A plus B, where A is the value of the part that's been sold, so that will be the £150,000, and B is the value of the remainder. So we have the 150,000, that's our A figure, and the 50,000, which is our B figure. So we're basically going to apportion the cost based on those values at the date of disposal. The tricky bit is that we also have £12,000 that has been spent clearing and levelling the 3 hectares of land that were sold. Now that is an allowable cost, and that £12,000 relates completely to the part of the land that's been sold. So the twist here is that we can deduct the £12,000 in full, but only part of the £70,000. And you can use the scratch pad to do your calculations. 70,000 cost times the value of the part sold, the 150,000, divided by the total value, that plus the value of the remainder, is 52,500, which of course you can see is one of the answers. However, it's not the right answer. We also need to add the £12,000 that relates specifically to this disposal, which gives us the second option, and the answer is 64,500. The other answers, answer A is one that you might have got if you were not sure about the 12,000, so that actually works out the part disposal cost based on the 70,000 plus the 12,000 times the A over A plus B, and the £54,000, the other one, falls into the trap of working out the cost based on the number of hectares rather than the values. The next question involves a takeover. Slightly tricky to deal with. And the question is, what is Ash's chargeable gain in respect of the cash received following the takeover of Rock plc by Stone plc? And this is the second piece of information in our scenario. Rock is taken over by Stone. Ash had originally purchased shares in Rock for £21,000, and Ash is going to receive a mixture of £18,000 of cash and 25,000 shares in Stone plc in exchange for the original shares in Rock. And then we've got the value of the shares in Stone immediately after the takeover. Now, to work out what's going on here, let's just look at a little diagram. We start off, Ash, with the shares in Rock plc, which had a cost of £21,000. Then Rock gets taken over by Stone, and the shares in Rock are transferred to Stone. In exchange, Ash receives a mixture of shares in Stone and also some cash. So Ash has disposed of the shares in Rock and has received a mixture of shares and cash, and we need the values of those. The shares have a market value of £1.80 each, so that's a total value of £45,000, and the cash is £18,000. So basically, it's as if Ash has sold her shares in Rock for a total of £63,000. However, she's received a mixture of cash and shares, and the shares, of course, are not cash assets. They're no good for paying the capital gains tax. So the rule is that we're going to step in the shoes. The shares in stone will take over part of the original cost of the shares in Rock, and there won't be a gain on those until they're eventually sold. But for the cash, the £18,000 that's received, we're going to treat that essentially like a part disposal of those original shares. So the rest of the cost of the shares is going to be apportioned and deducted from the cash to work out an immediate gain. So the gain is going to be the £18,000 of cash less part of that cost of £21,000. Going back to the question, we've got 4 possible options, and one of those we can immediately rule out, which is the £18,000. That is purely the cash received. So that at least means that we've got a choice of 3 answers. And to work out the gain, we're going to apportion the original cost of the shares based on those values at the time of takeover. Now, you don't really need to do this full working, but this certainly helped me to understand what was going on. And we've got the original cost of £21,000. We've got the value that Ash has received, the shares and the cash, and we're going to split that £21,000 cost between those two in proportion to the values. So the cost of the shares that have been exchanged for shares is going to be £15,000. We take the £21,000 times the value of the shares divided by the total value, and the balance of the cost, £6,000, or £21,000 times the value of the cash divided by the total value received. So that £6,000 is going to be the cost of the shares that are deemed to have been sold for cash. So our gain is the cash of £18,000 less the £6,000 cost of the shares that have been sold for cash, which is the first answer, answer A. The second answer, instead of using the market value of the shares received, used the £1 par value, the nominal value, which is wrong. And the final answer, I think, was calculated by dividing the cash by just the £45,000 market value of the shares rather than the total value of £63,000. So that one was quite tough, but even if you weren't entirely sure, you could certainly rule out the third option and have a 1 in 3 chance of getting it right. The next question is all about compensation received for an asset that's been destroyed. And the requirement here is for the base cost of the replacement antique painting for capital gains tax purposes. The base cost means the cost that we're going to use for CGT purposes. In the information, we've got a painting that's been destroyed by fire. It was bought for £27,000 and Ash has received £59,000 of proceeds and has then reinvested all of that amount and a bit more in a new painting just a few days later. And it says that Ash is going to make a claim to roll over the gain from the receipt of the proceeds. So the idea is then that the cost of the replacement is going to be reduced by deferring the gain that will arise on the receipt of the insurance proceeds for the old painting. Now, without doing any workings, looking at the options that we've got, £59,000 is the insurance proceeds received. So we know that that can't be right. That's the proceeds that we'll use to work out the gain initially. The 61,200 is the cost of the painting without any adjustments. So that's not going to be right because we're going to roll the gain over against that. We've got 29,200, so that's not obvious just yet. And then the £27,000 was the cost of the original painting. So again, it can't be that one. So it pretty much has to be the third option, which is 29,200. But let's just work that out a little bit more scientifically. The gain on the old painting, we treat the insurance received as proceeds, take off the cost to give a gain of 32,000, and that will then be rolled over, so that will be deferred. It won't be taxed now because all of the proceeds have been reinvested, but it will be deducted from the cost of the new painting. And as predicted, that gives us the third answer, £29,200. The next one is what looks like quite a straightforward calculation of Steve's capital gains tax liability. The information tells us that he's got a chargeable gain on the disposal of a table, but no other disposals, so we know that his annual exempt amount will be available. And then his income is employment income of 46,000. Just be a bit careful there because it looks like he might be a higher rate taxpayer. However, if that's his employment income, then that is before deducting the personal allowance. And if you look in your tax tables, we've got the personal allowance of 12,570, so that would be deducted from the employment income, which means then that some of Steve's basic rate band is going to be available. So we need to work that out. And when it comes to the capital gains tax, we've got the annual exempt amount of 3,000, and because this is not residential property, we're going to be using the normal rates, 10% within the basic rate band, 20% in the higher rate band. Calculate the taxable gain, 2,700. The taxable income is 33,430, which leaves us with basic rate band remaining of 4,270. And in actual fact then, all of that taxable gain falls into the basic rate band, so it can all be taxed at 10%, and the answer is 270. And as usual, the wrong answers. The first one is if you forgot the annual exempt amount, you would then be taxing all of the gain, partly at 10%, partly at 20%. The second one, easy mistake to make, forget the annual exempt amount and then tax the whole thing at 20% if you thought that Steve was a higher rate taxpayer. And the final one is if you use the AEA but then forgot to work out the remaining basic rate band and taxed the gain at 20%. The final question doesn't actually need the information from the scenario, although we are told that Ash and Steve are going to potentially put assets into their joint names before selling the asset in future. We can really just answer this one by looking at the information that we've got here. And we need to establish whether the following statements are true or false regarding possible capital gains tax planning benefits if we put an asset into joint names with a spouse before the asset's disposal. If you remember that a transfer between spouses is at no gain and no loss, and then when the asset is eventually sold, whoever sells it gets the gain or loss as if they've always owned it. Now this is something that we can use to make the best use of annual exempt amounts. We can make sure that both spouses use up their annual exemption by transferring an asset to the other before selling it. Same with capital losses. If one spouse has capital losses, then we transfer the asset to that spouse before it's sold. But transferring before the asset's disposal is not going to change the capital gains tax due date. If we were going to sell the asset on a specific date, then whoever sells it, it doesn't make any difference. The CGT will be due at the same time. However, we could reduce the amount of capital gains tax payable if, let's say, Like in this example, one of the spouses still had some basic rate band remaining and the other was a higher rate taxpayer. So that's the final capital gains question. As we can see, some of these were easier than others, but do make sure that you answer all of the questions and don't rush through them. Think very carefully before you answer. Think about the other options, the wrong answers, because if you get it right, you score 2 for each one. If you make a small mistake, you score 0. And the more you practice, the easier it gets. That's the end of this debrief of section B. I hope you found it useful and I wish you all the best with your exam.